Ladies and gentlemen, welcome to my teaching video on strategic mergers and acquisitions management, one of the sexiest and most exciting aspects of business life. We will concentrate on a corporate buyer perspective, but nonetheless, this is initiation into the world of M&A. The learning objectives for this module are: first, getting an overview of the global M&A market. Second, comprehend the basic concepts and vocabulary concerning M&A. Third, understand the role and importance of M&A for the performance management process of companies. Fourth, comprehend the M&A process from the buyer side of a strategic corporate investor. And five, reflect on pitfalls and success factors in strategic M&A. If you look at the sheer volume of the global M&A market, you'll find that it's fluctuating a bit, but over the last 13 years, you see that it has been fluctuating from between roughly $2 trillion to almost $5 trillion. And just to put this into perspective, the overall economic activity in Germany in 2019, measured by the GDP, was $4 trillion. So we can deduct from that almost the whole economy of Germany is being sold in, or can be sold in, one average year. Another interesting perspective is looking at different industries and their M&A volumes here. And in 2019, the big three were energy and power, biotech, and media and entertainment, followed by software and retail. Here again, this is fluctuating and just showing one particular year. Nonetheless, it's another interesting look at the international M&A market. M&A deals grab the headlines of the international business press. And if you read the international business press, or even the German business press, you will notice that these deals are talked about. So we had, for example, in 2014, Facebook buying WhatsApp for $19 billion. 2015 saw Dow Chemical buy its long-term rival DuPont for eye-watering $130 billion. In 2016, Linde bought Praxair. The German company on industrial gases bought Praxair for $85 billion. Bayer bought Monsanto, and that was a very controversial deal in 2017, and we still see the repercussions and the legal debate going on. The deal was worth $64 billion. The consolidation in the entertainment and publisher market was fired up in 2018 by Walt Disney buying 20th Century Fox for $80 billion. And 2019 saw Bristol Myers Squibb buy Celgene, a pharmaceutical company that was concentrating on cancer drugs, for $74 billion. What will be next? Nobody knows, but there's a constant stream of deals going on and being prepared. The international M&A market has nourished a global transaction industry. On the one hand, we have institutional investors and lenders, and on the other hand, we have specialist service providers and regulators that try to act as watchdogs in these markets, providing the necessary market transparency and trying to avoid monopoly situations. So let's talk about the institutional investors and lenders. Here we're talking about money looking for opportunities. That can be insurance and pension funds or sovereign wealth funds like the ones from Norway or Saudi Arabia. Could be hedge funds, private equity, venture capital funds. Special venture capital funds are, as the name says, for startup investments. We have commercial banks and corporations. The corporations play a dual role here. On the one hand, they act as strategic investors. That means they buy companies for strategic reasons to help them progress on their profitable growth path. And on the other hand, they act as venture capitalists. That means they are investing in startups, they are nourishing a ecosystem of startups for whatever reasons, learning, growth, for external R&D, and so on. So these are the investors and lenders, and we have special or specialist service providers. Overall, the transaction fees could be up to 5% of the total deal. So you can see this is a lot of money. This is one of the reasons why this business is so sexy, but on the other hand, it also attracts a lot of people. We have investment banks, international law firms, the big four accounting firms are not only interested in doing the due diligence, as we will see, but I'll try to get more of the transactional value. Then we have a lot of, or a plethora of big or boutique advisory service firms, small advisory firms that also just are small deal makers or specialist advisors on niche industry and so on and so on. We have proxy solicitors. That is a very shady and interesting kind of companies. They are dealing with the shareholders in the boards, and they will play a very important role when we talk about organizing majorities for transactions. And last but not least, there are public relations agencies, because these kind of deals also have a public relation dimension. So at the other hand, we have regulators. We have the classical antitrust authorities. They want to make sure that a horizontal merger of equals does not lead to a monopoly situation where one company exercises too much market power, which of course is the aim of horizontal mergers. We have special agencies for cross-border M&A. So some companies or some countries protect their key assets from acquisitions from abroad. For example, the US has special agencies that concentrate on Chinese M&As on American soil, and so they make sure that they don't buy critical security assets, for example, like havens. Then there are environmental agencies or trade unions who are well organized and can provide important impetus for deal making or blocking a deal. They're wielding more or less indirect power, but especially on the public relations side and on the side of winning the reputation or losing reputation, they are very important players. Overall, this industry is big, international, and you can even see tendencies that they're local companies, or so where we have, for example, the venture capital funds that are interested in Berlin, trying to take jump on the opportunities arising from the startup market here. But yes, overall, this is a huge international industry. They are well paid, the highest paid in the world. They are working hard, and at the same time, sometimes they just earn money for making a deal, for organizing a dinner, and being there at the right time and connecting the right people. When we talk about M&A, mergers and acquisitions, there's usually a misunderstanding. We have the acquisition, and the acquisition means we buy a company. And we can buy either all the assets of a company, or then it's called an asset deal, or a share deal. What's the difference? An asset deal would be particularly interesting if a certain legal entity has a lot of debt or has a lot of obligations, legal obligations, and we don't want to get into that problem. So we just buy key assets, maybe the most important assets of the company, and then we basically have everything we wanted and leave the rest lying around. Of course, most legislations have found out that this is an interesting way of dodging legal responsibilities for buying a company, and they have made clear that asset deals are dealt with in the same way as share deals. And share deals means just if you have the majority of a company, or depending on the legislation, 80% or more, then it's your company. Especially for publicly listed companies, this is a very important definition. If you own the shares, it's yours. On the other hand, we have mergers, and mergers sound like fusion, coming together of equal partners, right? Like in a marriage. In most areas, this is just marketing talk, because we actually have an acquisition. And in most of the cases, we even have the integration into the lead entity. So that is basically an acquisition. And in some cases, we actually have a new combined entity. So in this case, one might talk about a merger of equals. Usually this is not the case. But this is the M&A market. If you keep on going with the M&A poetry, we have other words that you will encounter when you read about M&A. So we have, on the one hand, the hostile and friendly takeover bids. What does it mean? A hostile or friendly takeover bid is defined by the reaction of the company to be bought's management team. If they say, yes, the offer that was presented is good and we recommend our shareholders to accept the deal, then this is a friendly takeover bid. If, on the other hand, we have a situation where the target company's management says no, right? The offer is really not acceptable. It's undervaluing our company, and we are strongly advising our shareholders not to accept the offer. Then we're talking about a hostile takeover bid. You might say, in any case, the management of the target company might lose its jobs and might be not at all interested in being bought. That's an important fact that companies have dealt with. And usually they have a change of ownership clause. The executives have a change of ownership clause in their contract saying, hey, if there is a change in ownership, meaning the company is being bought by somebody else, they will get a one-time payment and their job is done. Which means if you're getting into a situation of being bought, you get a $50 million US dollar check and you're out of all your obligations, which means that is somehow twisting your interest towards being more receptive for takeover bids. Yes, before we go into the kill zone merger, I'd like to talk about the white knight, because it's related to the hostile takeover bids. Hostile takeover bids might be quite successful because they are not paying too much money, and maybe they have a clear plan, maybe a lot of synergies that to be realized that some people don't like. But the white knight would be there to help the target company to not get in under the control of the predator company. The white knight would be the savior. a friendly company that takes a substantial part of the shares to protect the company from being taken over. That's a white knight. If the white knight is not there, and not every M&A situation is a fairy tale, there might still be a poison pill as an option for the target company to protect itself from the attacker or the predator company. And the poison pill would be something we eat, something that makes us toxic to the acquiring company. That could be we engage ourselves in an M&A deal that would make it very uninteresting for our predator to buy us. It could be that we take on additional loans, or one interesting poison pill would be, we talked about the change of ownership clause, to give maybe a large portion of our employees a change of ownership clause, or a clause that says in the case of a change of ownership, every employee gets a 50% rise in their salary. And of course that's true for maybe 2 years. And of course you might say this doesn't change anything, and most of the employees would sign such a thing, but it would eventually render impossible the business model for an acquiring company. So this is the fairy tale story about hostile and friendly takeovers, white knights and poison pills. Let's talk about kill zone mergers. Kill zone mergers are mergers where we have companies that enter the ecosystem of other companies. And here we have especially the tech companies like Google and Amazon and Apple, buying companies that get into the way between the almost monopolistic situation of the tech company and the customer. In this case, even the companies are bought just to kill them, right? They're just destroyed, and then they're gone, and we can continue with our work. So let's take the imaginary case of a company that would make oil superfluous. Of course, oil companies would have a big interest in acquiring the company, getting a hand on the patents, and make sure that nobody sees it, and that this magic patent will never destroy the business model of the existing oil companies. So there's a lot of M&A poetry going on, much more than this, but this is just an introduction into M&A. If you look at M&A as part of the strategic performance cockpit of corporations, we see that companies try to develop their business models. They are in the way of transforming their business, and part of their strategic planning and development process, and also part of the investment planning, is the M&A process. So mergers and acquisitions, especially in times where the markets are mature, offer a way for growth, margin growth, but also just top line growth in times where we've even shrinking markets. So over the last decades, M&A activities have become a regular part, if not the essential part, of strategic planning and management. When we look at the strategic plan, for example, of a plan for 2025, we see that there's usually an existing business for the companies, and they expect organic growth to a certain extent. That means new business areas evolving around new ideas or new market entries, and we have external growth options. And these external growth options are usually acquisitions. In this case, we have the green and the red acquisitions, and so their planning and their long-term plan, they have in their portfolio to buy companies. We'll look at that in more detail, but in all the important strategic plans of today, you usually find a notion of what is your M&A strategy for the next year. Talking about M&A motives and the motivation, we can briefly summarize two different areas. On the one hand, we have strategic motives, and on the other hand, we have all the other motives. On the strategic motives, we have horizontal integration, vertical integration, conglomerate integration. We will talk about that. All of that has the aim to improve and grow the business. In other words, they're an important ingredient of the growth and profitable growth plan of the companies. So when we talk about horizontal integration, we talk about merging or buying companies that are doing the same as us, so our direct competitors ideally. Why would we do that? We would merge similar functions organization. We just need one marketing department, maybe just one accounting department, maybe just one R&D department. We could generate economies of scale and scope and increase our market power because we are a bigger player in the market when we have more purchasing power. And of course, we have a higher impact on creating customer demands. Horizontal integration usually is seen very positively by the markets because there's a very clear rationale behind it. We are increasing market power, so we maybe get into more monopolistic situation or oligopolistic situation, which at the end would lead to higher profits. Or yes, and this is definitely a nice job because usually if we do a horizontal merger, we're talking about the same industry and the risks are relatively limited because we understand the industry we are in. At the same time, it could be that exactly this is a problem and that our industry is not so interesting anymore and maybe we should do something else. Let's talk about vertical integration. Vertical integration means we go up and down in the supply chain and either buy a supplier or a customer. So I've seen both, and quite interesting to see that we can even buy a customer if that particular customer decides maybe to go out of business and is no longer interested in the continuation. Here we have some economies of integration, but most we are talking about the assurance of supply and sales, right? One example would be rare earth. Siemens bought Lynas, an Australian company that provided and still provides rare earth. So they're mining rare earth. Rare earth are actually neither rare nor earth, they're actually metals, but they're it's very difficult. At least it's generating a lot of toxic waste if you extract them from the sands, and therefore it's for a long time only China was sourcing rare earth. So they said no, maybe if they decide to say no, we don't want to export rare earth anymore, then companies like Siemens wouldn't be able to produce electronic equipment anymore. So yes, assurance and supply of sales is a very important part. If you think about new M&A topics like venturing, corporate venturing, a lot of companies also looking for supply of new ideas and patents. And so a special area would be you buy, for example, as a pharmaceutical company, a biotech company that is maybe a small laboratory developing a successful patent for a drug, and it's maybe much more effective and cheaper to buy companies at an early stage and getting direct access to the personnel as well. Okay, all of that in the vertical integration. Conglomerate integration is something different. Here we talk about we buy another company that's not at all related to the industry we're in. So we're adding different types of businesses to our existing business. So for example, we are in the machine tool industry and we are adding a service line where we have people taking care of cleaning, for example. You might say this is counterintuitive. Yes, but this diversification might have huge advantages. For example, especially if we have different businesses that follow different business cycles, and so especially if they're canceling each other out. So, for example, we have companies we have consulting companies, and they have transaction business and they have business for restructuring. Usually, if the economy is going fine, then there's a lot of M&A deals along, and then we have a lot of transaction advisory services to be sold. If the economy is going down, we can do a lot of restructuring services and sell a lot of restructuring advice. Both mean that both have maybe similar characteristics as far as the individuals are concerned and their skill sets are concerned. So big advisory companies like the EY or McKinsey, they can switch from restructuring to growth topics or transaction topics. Yes, the economies of scope would mean that if the bigger we are, the more we can spread our managerial expertise on the different businesses we have. Conglomerate integrations were not loved by investors. The main reason is that they believe that companies that focus on one business model and one industry are usually run better in a more focused way, and that there is a conglomerate margin to be paid, that you have to actually if you break up conglomerates, you would get more value than integrating them. So yes, conglomerate integration, however, has seen an upside in Asia over the last decades. If you look at Tata or the Indian corporations or Samsung, we see companies that have a huge scope of business, from building warships to running hospitals, building mobile phones, and running steel mills. All of that can be integrated. So yes, conglomerate integration is an interesting thing. However, as a strategic motive, limited. The genesis of these conglomerates also is usually a different story, where they started, in the middle of nowhere, they started a machine tool company and found out that they need to run a hotel and run a hospital and run their own power station as well. So out of that, they developed into huge conglomerates. So if we talk about, these were the strategic motives. Again, here we talk about preparing our company for the long term, for profitable growth. And there are other motives as well. On the one hand, we have performance-oriented, basically for financial motives, and we have for psychological motives, irrational motives. So let's start with the financial motives. Undervaluations of companies offer the rare opportunity to buy them cheap. Maybe even so cheap that you wouldn't believe. And if that's the case, we talk about a lucky buy. And the corona-induced recession will probably lead to a lot of companies going bankrupt. And yes, there's a huge chance that a lot of companies might get bought out of bankruptcy or just before bankruptcy, and usually at a discount. And if the discount is high, that might be a lucky buy. Then financial resource optimization could be a topic. Financial resource optimization, what does it mean? For example, we had in some companies we have limitations to get the money out of the transfer money out of the country. So we had that for many years in Brazil. So getting money into Brazil was easy, euros or US dollars, but if you wanted to get it back, you had to pay additional money. So instead of just accumulating money, you buy more. And financial resource optimization might be also something like might go into that direction. Usually it's also related to taxation issues. One of the cases for the US was the US has an interesting tax regime where you pay taxes on everything you do worldwide, and even if until Trump changed the situation, the American tax rate was the highest in the world. So what did the companies do? They did not transfer their money back to the US. Actually, they had an interest in taking up loans in the US to pay their investors, pay dividends, and keep the rest offshore. And so they invested in other things somewhere else. And if you want to invest sooner or later, if you have bigger amounts of money, you won't get around the option to buy other companies. So most of these areas are performance oriented, and there is ultimately a financial motive for it. Sometimes they can be combined with strategic motives, but usually these are short-term financial motives. And then there are these psychological motives, so hubris, where of course it's very nice to be the biggest player in the world, to get your own corporate Learjet to fly you from here to there, and the idea that you're the master of the universe is something that is appealing to many managers. It would be to me. Market mania is another topic. Market mania is the underlying idea is that if you don't buy, people will buy you. Monsanto obviously in 2017 in January was very aggressive in saying that they want to buy companies. That they ended up being bought is maybe ironic, but market mania means that you have to be aggressive, otherwise you get eaten. Yes, and this empire building, we talked about the empire building, but also about it's connected to the hubris. We are overestimating our ability to change the future and to have impact on other companies. So usually, most of the time, we have very irrational things going on here, and rarely they translate into value generation. When I talk about the M&A process and execution, I'll take up the perspective of a corporate strategic investor, right? And we talk about an idealistic process that usually doesn't end up this way, but this is just this is the ideal way of doing it. So we have different phases and activities that lead to results. Let's start with the M&A planning. So we have a strategic plan, and out of the strategic plan we decide, wow, we also we have an M&A strategy, and we have clear acquisition objectives. For example, we want to get a foothold into the South American market or the Chinese market, and we have an implementation plan and dedicated resources. In this case, probably an M&A department, which is not really cheap because we need at least one person who has experience in the transaction industry. These individuals are usually highly paid, and we need clever people working with them. So this is an M&A plan. We have an M&A plan with dedicated resources. We are ready to go. We have an army of well-paid well-educated M&A specialists. So then we go on and research for the targets. Let me talk about personal experience. My last job I was working on was with a FOIP paper, and I worked on an area called MRF, Material Recycling Facilities, adding or being added to paper mills. That was a big thing, obviously, and the board said to me, "Hey, Albo, isn't that a wonderful thing? Look at one of the companies. Maybe we have to buy one of them if they're an important player here." Good, I understand. So let's do the research. So what did I do? Of course, I Googled it because I had no idea about the industry. So I Googled and I found out that there were trade fairs going on with especially these where all these market players were around. So I took one of the last hotel rooms in Cologne and went there to look at went to the trade fair and talked to the market players. I invited a lot of people for dinner and lunch, and we talked. And I got an interesting overview within 2 weeks about the market. Got a so-called long list. So what does it mean? I had an overview about what are the players in the market, who is up for sale, who are what is the reputation of the individual players, and I got all the business cards of partly of the executives or partly of the salespeople. So came back to the board saying, "Hey, this is what I've done. We now have a long list. Here are the players. What do you think we should be doing?" Oh, okay. We developed criteria. What kind of companies do we want? And especially I, now together with a technical engineer, started visiting the companies. Just in a way where we would say, "Oh, this is interesting. We are considering collaboration and whatever nature." And most of the companies were very willing to talk about us and show us their products and their lines and their facilities. So this is interesting. We also tried to develop business case and found out where are the companies that have an idea about the paper industry. And with one of our customers, we arranged that we would become technical advisors of a project where they were actually installing a MRF in England. So real business case. We went there. All the players actually that we met before were also there, providing us with all the interesting project materials, and we then afterwards came up with a short list. The short list is the list where you see, okay, we now have 1, 2, 3 players that we would consider buying, and that actually one particular company that was of special interest for us, located in the US. The board agreed, and we signed a non-disclosure agreement. The non-disclosure agreement means that we want to get into closer contact, eventually disclose data that is not for public, disclose our weaknesses and strength, and our weaknesses and strength. So the non-disclosure agreement is there to protect both parties from leaking information. It's a clear indication we want to talk closely about each other, but we also want to make sure that nothing is disclosed, and that's the beginning of a due diligence usually. That means, hey, we want to engage to something more concrete, and we want to play with open cards. And this non-disclosure agreement is there to protect us. Unfortunately, there are a lot of cases where people even signed non-disclosure agreement and then went into due diligence just to take all the information that they gathered to use later against them. Due diligence. The due diligence is the process of taking the necessary care, look into all the details to make sure that the deal can be evaluated fairly, right? Looking about the risks, the opportunities, you want to make sure that you have a good understanding about the other company, also to make sure that you plan for your integration phase. Therefore, the due diligence is a very important step. We'll talk about that later as well. The due diligence involves going to the places, looking at the numbers, and so on and so on. There are also very formalized ways of dealing with due diligence, and there are a lot of players that help you with the process. At the end of the day, you want to come up with an evaluation, and so the amount that you want to pay for the company, and that also depends on the assumptions you make about synergies, business development, and so on. You structure the deal. Could be an earn-out clause. There could be maybe a deal where you just where the owners still have to be present, and where they will. It's in their best interest to act as if they still were entrepreneurs to make the thing going. And at the end of the day, there is contract. There's then the closing. The champagne is out of the fridge, and we have a deal. This is wonderful. So when we talk about integration, we have this PMI, stands for post-merger integration. This is usually where all the problems come to daylight that were not seen before, and so the integration planning actually starts with the due diligence, and the integration has several dimensions. Of course, a people dimension. There's an operational excellence dimension. So especially if you have a manufacturing business that you want to run, you have system selection questions. What kind of ERP system do you want to choose? What kind of solutions do you have to integrate the company into your corporate structure, and how to develop the business, especially if your intention is to build on synergies. And if that is going well, you develop synergies, or if it's not going well, reverse synergies. The M&A process and its execution can follow this ideal path. It could also happen that you just have a handshake and somebody agrees, poof, this is what we want to do. Unfortunately, big corporations usually have corporate governance that requires a lot of checks and balances and makes the process rather formal. So yes, it is an idealistic process, and it is much more interesting than this slide suggests. Due diligence, as I said, the necessary care. That's a huge topic that I can unfortunately not dive into all the details. Understanding the finances, the operations, tax and legal plays a huge role in international transactions. The human resource area, technology, understand what they really have. What are the patents worth? What about the IT systems? How compromised are they? And what about the management team? Are they good? Will they integrate well into the company? Do they fit into the corporate culture of the acquiring company? All of this is something that is dealt with in the due diligence, and the due diligence is also partly outsourced, or can be in many cases is outsourced to the big four accounting firms, but it can also be done by big corporations on their own, maybe aided by some external advisors. And this is a classical case where people who know how to read financial statements, who have broad understanding about performance management, are integrated. So this is how I, as a performance manager, as an internal auditor, and strategy vice president, was personally involved in several of these due diligences. Quite interesting. At the end of the day, as I said, there will come out evaluations and recommendations based on the risks and opportunities identified. So, M&A synergies. People always talk about synergies. What does it mean? So on the one hand, we have sales growth. That means that people expect from the M&A deal additional growth rate due to cross-selling potential. That was the rationale behind the bank assurance deals in the 90s, where you say, okay, where a bank buys an insurance company and they can cross-sell their products. There might be synergies in the price quality. So if we can consolidate the market further, that might usually lead to higher prices. And of course, that's good news. Material cost reduction would be due to economies of scale and increased purchasing power. Tax synergies, that is an interesting field where we can take loss carry forwards and additional interest payments to lower our tax payments. So we might eventually just buy a company that has accumulated loss carry forwards and is now almost insolvent, and we buy it out of bankruptcy, and we can buy it for cheap and then still use the loss carry forwards. There are some conditions that apply, and the deal might be useful just for tax reasons, even if there's no operational deal necessary. And yes, restructuring is the key synergy driver, where annual cost reductions are materialized by reducing employees. As simple as that, and this is also why most companies and most trade unions are against M&A deals. An important question is, how much do we have to pay? Is it the book value, which is basically the shareholders' equity, a financial number, and bookkeeping idea? Total assets minus total liabilities, so the shareholders' equity. Usually companies do not get over the table, but just by their book value. When we talk about the intrinsic value, we have in mind the idea of the net present value of the expected cash flows from the existing business model, right? This is basically the discounted cash flow of the money-making machine that we are buying, the intrinsic value. And yeah, you might say it's difficult to assess, but yes, this is the idea. The synergy value goes beyond that. The synergy value takes the intrinsic value and adds the additional synergy value, the additional sales growth, the cost reductions, and so on, to make sure that we take all the benefits and costs from the transaction and anticipate the synergies of the deal. This is synergy value, and you might say this is probably the highest possible price that we would pay for a company, right? The takeout value is usually calculated by benchmark multiples. So there are some companies that if you want to take a company off the market, we know the market value is the number of shares times the share price at a given time. This is, however, only representing a small portion of the total shares, because most of the shares are not up for sale. So if you want to take out a company, that means take it private, you have to pay a premium. control premium or a takeout premium. This is calculated by companies or with reference to similar cases, and you calculate, for example, multiples. The multiples could be multiple of an EBIT multiple. You could take even a sales multiple, and these kind of multiples of the takeout value also important reference. And if your synergy value is lower than the takeout value, you probably won't have a classical chance to win this deal. M&A valuations in a nutshell. Actually, this is a huge topic, and you can spend a whole course just on M&A valuations. At the end of the day, it's also not just rocket science. It depends on more or less volatile assumptions about the future. But here we go, the M&A valuations and the price are very important aspects of failure or success of a deal. M&A are investments under risks, and they are quite substantial. These risks are substantial because we're talking about lots of money that's involved. We talk about reputational risks, and we talk about information asymmetries. So apart from that, we know that especially on cross-border deals, we have failure rates of 60+%. That means more than almost 2/3 of the company deals cross-border M&A are considered failures because they did not achieve the originally planned objectives. So there are a lot of things that can happen, especially for cross-border deals, but not only. First, politics. Yes, and here we're not only talking about the antitrust authorities and the watchdogs. No, yes, of course, they play a role, and there might be ministerial exemptions for your situation or not, but they are playing this game of big deals also involves politics. There are also politics, could be geopolitical situations. For example, if you invest in Russia and then you find out that there are sanctions put onto Russia, you will probably have problems realizing your synergies and your full potential of the deal. If we look into markets also might develop differently than you expected. Synergies only work if the markets follow your or beat your expectations. There might be other problems like arising from the operational side, where you see, oh, you just cannot get the right people, or you're losing people. Or there might be an issue of liquidity, where you find out, oh, actually right now in the coronavirus situation, you find a lot of companies say, oh, I know, we don't want to do the deal, we don't have the money right now, or we don't have the money to invest and develop the business as originally planned, and then it would lead to failure almost naturally. When we talk about integration strategies, we think about learning and synergies, but there might also be areas like we just want to conserve the business that we have, or we might forget about it. So when we learn about fusion, that means mergers of equals, where we can learn and realize synergies. This is, of course, how we sell an M&A deal to the public and to the target company. But at the end of the day, we might have other motives. One motive might be that we just we want to conserve the company. We don't want to generate synergies, especially if we, for example, buy a supplier. We might want the supplier to remain a certain autonomy and develop a partnership with it, maybe close and privileged partnership, but that's it. Could also be that this could also be the strategy for integrating a diverse business that is part of a conglomerate merger. I would just leave it also maybe because we're respectful and humble and say, oh, we don't really know how this market works, and we leave it to the existing management to deal with that. Another option might be quarantine. Quarantine means we for example, buy a company, maybe a startup, and we don't want to get tinged by their culture or by the risk and their reputation. So we don't talk about it. We buy it. We don't integrate it at all. We keep it as it is, but we don't even talk about it, that we bought it, at least not if we can avoid it. We might eventually not consolidate it in our numbers, and there could be the area that we want to sell it later on, and we don't want to get too much involvement, or that we just keep it as almost like a kindergarten or a sandbox where we see what's happening to them. Maybe it's an interesting ecosystem of startups that we generated, and just want to see how they're working, how they're dealing with situations. But we don't want to mix it with corporate culture, not only because the corporate culture could be tinged by their strange new work culture, but because corporate culture might actually stifle and destroy the culture of the startup. So quarantine can be beneficial for both sides. Another area, and the last one, would be evisceration. Evisceration strategies means we take the company, we buy it, and we take out what's important for us. Maybe markets, maybe customers, maybe patents, and then we just kill it. So the brand name might be taken off the market, and we took the channels, we took some kind of infrastructure, some people, not necessarily, and just took the rest off the market. Kill zone mergers can be partly follow an evisceration strategy. So these are integration strategies. So the interesting thing about integration strategies is that not all of them really want to integrate. So we're drawing to an end, but let's talk about the advantages and limitations of M&A. So in a nutshell, the advantages: we might increase corporate power and improve market share and product lines. So we might ideally create an oligopoly, or even a monopoly situation. The achievement of synergy effects, which means the result of the combinations is greater than the sum of the parts, right? 1 + 1 = 3. That's the idea. That is a promise of a good synergy, of a good merger. It might be a mean to raise financing. Yes, absolutely. And it might maximize shareholder returns by improving stock market price. And for especially, so not engaging in M&A would probably raise more questions. And yeah, there are a lot, as we said, there are some tax benefits involved. Limitations, as I said, high risk of failure. There's a history of even epic M&A failures. The German case of Daimler buying Chrysler and the merger of equals might be here to just illustrate, but there's a whole history, and it's worth going there. And there are a lot of videos just about the epic M&A failures. Reverse synergies are the opposite of synergies. Actually, there's a lot that can go wrong, and usually goes wrong with M&As. Most of the M&As are not very successful. What is clear is that there's a high cost of the process, and there's a huge, we talked about the huge transaction industry that's dealing with it, and they are well paid, and regardless of the success of the deal, they are interested in a high price because they are paid usually in a percentage of the total deal value. So we have the adverse financial effects. Yes, absolutely. If the benefits do not materialize, and then we might end up in a situation where we can hardly bear the loans that we had to take in order to buy the company. Yes, and another interesting thing is employee retention. So we might buy a company, but we cannot force the employees to stay, and some simply don't. And the best employees, and here we talk also about due diligence and the post-merger integration, will leave because in the target company, because you have the impression they will lose anyways, because the colleagues from the new company will take over, and you might lose key personnel from the very beginning. Success factors, if there are any, probably it's a strategy. If you have a long-term strategy and you know what you're doing, that's actually a good proxy for not destroying too much value, and understand and long-term perspective on the process important. As Warren Buffett said, value is what you get and price is what you pay. So make sure that value and price are in a good relationship, and don't be afraid of walking away if the price is just too high. This is something that you cannot make up afterwards. Leadership is very important, and at all stages, but especially after the deal. So usually the top management after the deal is eager to return to the desks and write all the emails that they couldn't answer before. But that's exactly the place where leadership and communication is needed most. Yes. Then there's discipline and rigor. Discipline and rigor. So since there are a lot of things that could go wrong, I think method is quite important. And the methodology, looking into all the different scenarios, looking into all the assumptions. If you have due diligence that is rather formal with the data room and things like that, make sure that you're really disciplined in this area, and make sure that you're following maybe also professional advice on that. And last but not least, governance is important. So it's always good to have a second layer of management over the management to make sure that they don't do anything wrong, because they are in some areas emotional motives can be dominant, and people don't want to walk away from a deal, even if the price is not okay, even if the story is not good, just because they want to be seen as deal makers. And governance is key. So the supervisory board might say, or the board of directors might finally say no, and usually these are good decisions. Ladies and gentlemen, thank you very much for watching. This was a teaching video as an introduction into one of the sexiest aspects of business. M&A management involves a lot of qualities from the performance manager, understanding not only bookkeeping numbers, but understanding planning, strategic planning, operational planning, understanding the business models, and it requires creativity to build stories of synergies and build the future for the combined entity. Ladies and gentlemen, thank you very much.